Welcome to day 12. Today we are going to talk about the real estate investment basics and ROI calculations. Calculating ROI is super essential for advising your investor clients. Now, investor clients differ from end user clients. For a lot of end user clients, their decision making is based on is the property right for their family? Emotional factors come into play. Location of the school or workplace might come into play. But for investors, the play is very simple. It's purely all about the numbers. If the numbers make sense, whatever money they're investing into the asset, whatever returns they'll generate over a certain period of time, if that makes sense, that's how they make the decision. So it's important to understand the differentiating factor between the two. So as advisors, we should be comfortable speaking the financial language of real estate to effectively pitch to investors. Because they look at ROI, they look at capital appreciation, they look at IRR, they look at cap rates, they look at growth perspective of that asset, they look at the return they can make based on the mortgages that they're taking, what are the interest rates the banks are charging. They look at various different numbers. For them, it's a pure play. You have to think about investors as in they have multiple avenues to put their money. So if someone's investing, let's say $1 million, they're not just thinking, shall I invest this $1 million into real estate? They're thinking, should I put my money into stock market? Should I put my money into businesses? Should I put my money into a FD deposit? Should I put my money into real estate? Should I put my money into gold, silver, or crypto, for example? So they're comparing the investment proposal you're giving to various other elements as well. They're not just looking at property to property comparison, they're looking at real estate to various other modes of investment that they can do. So you have to really show to them how the numbers are placed and why it's ideally suited for them to take that particular call. So let's start off with return on investment. That's the first thing we're going to discuss, which is ROI. ROI in real estate and how to calculate it. So for a rental property, ROI, which is often expressed as annual rental yield, is calculated based on net annual income, the net income that you're able to generate, which is the gross rental income, minus whatever the service charges may be, which is the net income, divided by the total investment, which is the total property purchase value plus whatever closing fee you had to pay, and into 100% to calculate it as a percentile. So let's walk through an example. Let's say your client is buying a property of 2 million dirhams, okay? And after whatever the closing fee may be, which is roughly around 5.5 to 6 to 6.5%, depending if they're buying on cash or if they're utilizing mortgage, their total investment works out to be 2.1 million dirhams. And let's say it rents them about 150,000 dirham as net rental income per annum. So perhaps the rental income gross could be 170, 175,000. And once we deduct whatever the yearly service charges are, which every landlord has to pay on a yearly basis, it's a fixed cost. You cannot avoid that. You cannot not pay that. Your property is vacant, you pay it. Your property is rented, you pay it. So whatever that cost is, once you deduct that, you calculate what your net rental income per year is. So when you look at the calculation, so if you divide 2 million, okay, plus whatever the closing fee is, you look at a total of 2.1 million. And if you look at the net rental income, which is 150,000, divided by 2 million into 100, you come up with a net rental yield of 7.1%. That's the net rental yield that you're able to generate for your investor based on their investment into this asset after service charges, maintenance, and everything. And you can always tell them that this is the current rental income that we're generating. There are ways to increase it. Every year you can have a certain increase of 5% or 6% or 10%, whatever it may be, based on how the market performs. So that's where the yield will go over time. So desirable ROI, which is something that your clients also need to know, that a desirable ROI in Dubai might range from anywhere between 6 to 12% depending on property type and area. Now, what are the variants? Let's say you go for a prime residential property in the most prominent area. It's a big ticket product, might be a villa or a nice penthouse, but in a prime location where the value will always hold and the appreciation will also be there, you might be sitting at an ROI of maybe 5 to 5.5%. Now, let's say you pick a category B area, which is, let's say, close to downtown, but not very far away as well. And you pick a smaller asset. It could be a 1 bedroom or a 2 bedroom and not relatively a larger asset, wherein your growth potential is also there. Rental demand is also good. You get a good family as a tenant. Your ROI could go as high as 7 to 8%. Let's say you pick an area which is further off away from the main city, and it's a category C area, and that's where the appreciation and the growth value is not that great. It's stagnant a bit, or it might appreciate by a few percentile because the location is not that much in demand, but a great area because service charges are lower, rental demand is good, the rentability is high, and you might be renting to bachelors or you might be renting to smaller families. You might even net a rental income of, let's say, between 9 to 10%. Now, this is within the residential category. Now, you want to have a higher rental income, you enter a commercial category. For example, you could be looking at a labor camp, you could be looking at warehousing. There, a commercial asset, of course, larger ticket size in a certain location where you get a tenant contract as a single tenant to sign off on a 1, 2, 3, or 5 year lease with certain rental escalation on a per annum basis. You could look at generating rental return of about 10, 12%. So this is the variance that you get within different asset class, within different location, within different property type in Dubai. Now we're going to look a bit into the mortgage impact on ROI. Let me just get rid of all the other numbers so that way we can run some more calculation. But let's talk a bit about mortgage ROI, because when a client is buying a property on mortgage, the entire calculation really changes, right? Because there is a certain equity involved that they're investing from their pocket, and then there's a certain amount of money that they're borrowing from the bank on which they're probably going to pay interest rate. So I'll just move this up completely. So on which they're going to pay interest rate, right? So that calculation then really becomes different. So what is the impact of mortgage on ROI? So we have to look at cash on cash return for finance deals. That's very important. I see a lot of people making the mistake. They look at it as, oh, I'm buying a 2 million dirham property. This is the rental income I'm generating. This is the amount that, for example, I'm paying to the bank based on my interest component on a yearly basis, and this is my return. But that's completely wrong. Because whenever we calculate the return on our investment, ROI is what? Return on investment. We basically have to look at what is the equity that we are deploying. For example, if you're buying a property of, let's say, 2 million, and let's say our equity deployed from our own pocket is 25%. 25% is what we are deploying from our own pocket. 75% is what the bank is lending us. Let's say we add some closing fee to our transaction, which is roughly 6%. So from our pocket, we are deploying about 31% of total funds, right? So that means from our pocket, how much is the total amount that's going? It's roughly around 610,000 or so. Let's consider it to be a approximate number. 610,000 is what we are deploying from our pocket. And how much is the bank lending to us? Close to about 1.5 million is what the bank is lending to us, on which we are going to pay a mortgage on a per annum basis. So when now we need to calculate our cash flow, or we need to calculate what our return on that particular investment is, we don't look at the rental yield divided by the total investment, right? We look at the rental yield divided by our equity in. So let's say we consider the same thing as the previous example, net rental income of 150,000 after service charges. Now, if you were to run some basic mortgage calculations, we could see that on the money that we are borrowing at 1.5 million, we have, let's say, interest component of at 4%. I'm going to do some high level calculations. I'm not going to use a calculator. It might be difficult for some of you to understand that. But if you just run through the numbers, you'll probably come with the same calculation. Let's say roughly at 4% interest rate, you're looking at of 1.5 million, a yearly payout of about, let's say, 60K, 60,000. And let's say you're taking that loan for 25 years. Based on that, you're looking at a repayment of about roughly, again, 1.5 million. That's the repayment. That's the interest you're going to be paying on the principal amount of 1.5. So total, you're paying about 3 million over a period of 25 years, which if you break it down into per annum basis, you're probably going to be looking at about roughly 105,000, let's say, yearly. So now you're netting about 150,000 based on rental income, and your yearly output on your interest component is 105,000, meaning your net income becomes now 45,000. Now, if you want to calculate your net rental yield, you divide 45,000 by the investment that you've made of 610,000, and that's where you are able to generate whatever your net rental yield is, which roughly comes up to be around, let's say, 6.8% or so. So that's the net rental yield you're able to generate based on a deal wherein you're taking a mortgage, because that's the equity that you're deploying. 610,000 is the equity you're deploying. Remaining you're taking from the bank. Although your yield in this will get better because over time your rental income will increase, but over time your capital plus interest payment will go down. Your principal plus interest payment will go down because you're paying interest, right? Every year, you're paying principal plus interest every year. So over time, your payments will go slightly down, but your rental income will go high. So after some time, you'll see that your net rental yield is going higher and higher and higher. So this is where you look at calculations based on you taking a mortgage on the asset. So in a lot of cases, whenever your clients are buying ready property, if they have access to mortgage, it's ideally suited for them to go ahead and take a mortgage on that particular property. Let's say they say, well, I have 2 million capital that I'm able to deploy, right? But if the profile is good, if the bank is willing to lend them money, and if they're okay to look at taking a couple of properties, you can actually ask them to diversify the investment of, instead of putting all 2 million equity into one asset, put 2 million equity across three different assets. Of course, with every second property, the loan to value ratio you get from the bank is going to go down, right? So perhaps you can look at deploying 600, 600, 600 into three properties as your own equity, or in some cases, you might need to deploy 700. But you can deploy that same capital into three different properties. You can take loan from the bank for three different properties, earn the rental income on all three, and after a certain period of 20, 25 odd years, whatever the timeline may be, you have three fully paid up properties, which you obviously wouldn't have been able to do if you were deploying your entire equity into that asset, right? So this is where a lot of investors are able to really build a property portfolio which spans 10, 15, 20, up to 50 assets, which after some time they sit on the rental income of and enjoy that. Property value is also growing, rental income is increasing, they're sitting on that particular asset, they don't need to worry about it, income is flowing into their pocket every day as they sleep. Now let's look at capital gains and flipping calculations. Flipping is something that's quite common in this part of the world, right? You must have heard about it. A lot of buyers buying off-plan property, paying 10, 15, 20 or 30 or 40, whatever the developer's requirement is, as a minimum payment in order to be able to resell it at a certain profit. A lot of people get it at launch, at initial stages where the property value is lower. The developers are increasing the property value over time in new launches. Market is going up. They got some good assets. They got some good units. After 1.5, 2 years, when their 30, 40, 50% payment have been done, they're able to resell it. That's called flipping. The calculations on what kind of profit and income you're able to generate on that are completely different, because once again, when you talk about off-plan property and flipping, you're not actually deploying the entire capital. If, for example, as an investor, we'll go through some elements, which is buying to resell at a higher price point. Um, if, for example, you're buying an asset, let's say at a value of 1 million, you buy off-plan property at a value of 1 million. Whatever the closing fee into that is, let's say you pay 4% DLD. Now, let's say you've deployed about, let's say 40%, whatever the required is to resell that property. You've deployed so far 400,000 within a span of, let's say, 1.5 year, plus whatever the 4% is, which is 40K. So you've deployed about 440,000 of your own capital into this asset, which after 1 year you're able to resell. Now let's say you're able to resell this property at 1.2 million in the market. Now what is your profit? You bought it at 1 million, you're reselling it at 1.2 million, meaning your profit is 200K. Now you're not generating 200K on an investment of 1 million, right? Yes, the property was worth 1 million, but you've still not paid the entire amount. Whatever you paid, you've paid 440. Now, how do you calculate the return that you're generating on this? Based on whatever your closing price is, and let's say it is 1.2 million, you're generating 200. 200 divided by 440,000. Based on that calculation, you're able to calculate what kind of return you're generating. This probably comes up to be close to 45% or so. That's the return on equity that you're generating based on property flipping. Because you bought it for that much, 1 million, you only paid 40%, you held it for 1.5 years or so, and you sold it at that. So if let's say you held it for 1.5 years and you're generating 45% overall return, your yearly ROI, your yearly return on equity in this case, which is ROE, is roughly about 30-35%, which is excellent, right? Which is great. 30% return on equity within 1 year is brilliant, which is why a lot of people enter this particular field, which is why a lot of people buy into off-plan. They look at the asset that they're getting, they buy it from a great developer, they enter right at the start of a launch, and they resell it after 1.5, 2 years. And of course, the profit is not taxed because there is no capital gains tax on property within this part of the world. So UAE has zero personal capital income gains tax. So whatever you're profiting, that profit is completely back into your own pocket. Of course, you got to consider whatever the transaction fee is, but you're only paying it when you're buying the property, right? The 4% DLD. Whenever you're reselling it, it's the eventual buyer that's playing. Hence, the flipping model is really interesting. A lot of people have made tons of money through it. You just need to understand what kind of developer to get it into, what kind of asset to purchase, when to put it back into the market to resell, and how to, of course, pick the right unit in order to get that particular gain for your investor. So that's a little bit about flipping. Now, moving on, we're going to speak a bit about the other investment metrics. So there are a few other concepts as well that once you start to speak to savvy investors, it's important that you know about them because that's part of their regular conversations whenever they look at investments. So something called cap rate. Cap rate is very similar to ROI, return on investment. It's called capitalization rate, but it's often used in commercial real estate. So whenever your investors are buying commercial assets, be it offices, factories, warehouse, retail, hotels, for example, they're looking at it as a cap rate. So what's their return? So similar to ROI, whatever the net rental income generated is in a certain year divided by the investment they made times 100%, you are able to calculate what the cap rate will be. Secondly is occupancy rate for a rental portfolio property. Now let's say your investor has 100 particular properties, right, in their portfolio. Now not every property is going to be occupied at all times. So let's say only you get occupancy rate of 75%. Let's say you're doing short-term rental. In short-term rental, in this part of the world, your occupancy rate can be roughly 70, 75, 80% or so, right? Because the summer months are running on low occupancy days. So when you calculate what kind of return you're able to generate for the whole year, whatever amount that may be, X, you got to calculate your return based on 75% of that only. Because that's the kind of occupancy rate you'll have. Not just for short-term portfolio. Even if you look at investors holding a larger portfolio, some of our clients are holding assets which are 300, 400 units and above. And even if they do long-term renting, right? Not every unit can be rented at all times. Let's say a long-term tenant leaves, it takes time to then renovate that if needed, maintain that property, clean it out, carry out any upgrades that are required to it, and then put it back into the market and to rent it. So you get 1 or 2 months of timeline, depending on if it's a bigger asset, if it's a 4 or a 5 bedroom villa. It takes 1 to 2 months to put it back into the market and rent it out, right? So you got to consider that timeline as your vacant time period. So you got to factor in what the occupancy rate is, and that can really play into your rental return or your ROI. Because if you've got a apartment or a villa vacant for 1 to 2 months and you're looking at whatever the rent you would have generated over 12 months, you're actually generating over 10 months only. So you got to factor that in. And lastly, an important concept, which is internal rate of return, IRR, which is a bit more complex because you look at it as a multi-year hold at a higher level. But how does it differ? So let's say your investor, for example, let me run an overall calculation going back to what we did before. Your investor bought an asset at 2 million. Okay, and let's say they were generating 150,000 net rental yield on it with closing fee of, let's say, 6%, which we did. We remember that the calculation was roughly 7.1% net rental income is what they were generating. Now let's say they held this asset for 5 years. That means every year they generated, without any appreciation, I'm saying without any increase in rental income, roughly about 7.1% net rental income. For the ease of calculation, I'll consider it to be 7%. That means in 5 years, they generated about 35% overall return on their investment based on rental yield. Now, let's say after 5 years, they end up selling this property for, hypothetically speaking, let's say, just for ease of calculation, because this was total 2.1 million. Let's say hypothetically they sold it for 3.1 million after 5 years, meaning the gain that they've generated now on the asset sale is roughly about 1 million. That's the gain that they have generated on that asset sale. Plus, they've made about 150,000 every year for about 5 years, meaning 150,000 into 5 is roughly about 750,000. Meaning, by buying into this asset for 2 million with a closing fee of 2.1 million, holding it for 5 years, generating a net rental income per annum of 150,000, and selling it after 5 years at 3.1 million, the total return that they've been able to generate is about 1.75 million. Now, in order to calculate the IRR, the internal rate of return on this, we look at what is the total profit that they've been able to generate against the total investment that they made. So if you look at it, 1.75 million divided by 2.1 million, you would roughly come around the range of approximately 80% or so. Now that divided by the holding period of 5 years. So 80% divided by 5 years equates to about roughly around 16 to 18% return. Actually, it's 16 because over there the calculation might have gone up slightly to 85% or so. But let's factor it to be 16%. So now your IRR, while your investors was calculating my net rental income, my ROI, my return on investment on this asset was 7.1% per annum. But if you look at it from a complex level wherein you look at the holding time period, the return you've generated and the capital gains you had and the profit that you made out of it, your IRR is roughly at around 16%. Now that's a great investment. This is how you position your investment to your client, saying that the IRR, the internal rate of return that you're able to generate after holding this property for X number of years, from renting around, from selling it, is roughly 16% on a per annum basis. Now, these are some of the terms that you ought to know when you're speaking to your clients, especially savvy investors, because this is what they look at us in advisors, right? They just don't want someone who can merely show to them a particular property and say, you know what, this is great, buy this, I can, whatever your offer it is, I can place it with the purchaser, with the seller, and I can try to get it for you. No, they're trying to see exactly, are you able to help them rent it? Are you able to help them understand what kind of return they can generate? Are you able to help them liquidate it? And are you able to basically get them in and out of their entire asset with a handsome kind of return or profit that they're able to generate? That's exactly why you need to know all of these terms. Now, risk versus portfolio strategy. So we have to understand one thing. Whenever we are talking to our clients, this is what we mostly do. Whenever we are telling our clients that, look, what kind of asset that you want to buy and why you're buying it plays a very important role based, because that's the basis on which we're going to guide you as to which property to look at. For example, my clients tell us that, look, I want a higher rental income because that's what I know is guaranteed. I don't want to gamble on the capital gains, or I don't want to gamble on the appreciation, because if it comes, great, that's a cherry on the top. But I know based on the market that I understand today, my rental income should be X amount. I want to generate 8 to 9% rental income. Great. I'm happy I know this from my client, because I know that he's not looking to take big risk, but he wants to be in an area where based on the acquisition price today, I can get him 8 to 9% rental income. Great. So I know what area to get into. I know what kind of asset class to offer to him. I know that it's ideally suited for him to buy smaller ticket size units and not get a large unit. If he says my investment ticket size is 10 million, instead of putting all of that into one asset, I'll suggest him to put that into 5 or 6 or 7 different assets. That way each asset can generate him higher rental yield. So that's a low risk category, but a higher rental income guaranteed yield kind of a category. But there are also certain investors who say, look, I want a capital gain. Like if I'm putting X amount of money today, I want to be able to exit after 2 to 3 years, and I want to be able to make 50% on top of it. And while none of that is guaranteed and no one can say where the market goes after some time, but looking at the historic patterns, looking at the growth that's coming into the area, looking at the future development, looking at the infrastructure, looking at the regional, looking at where the stock market is, looking at where the interest rates are, looking at where the inflation levels are, we're able to understand and determine where exactly which kind of direction is the market heading at. Of course, it'll not be all applied and it'll not be all work out to be correct, but to a certain degree we can. Now, if someone else tells us that, then we understand that fair enough. For this kind of client, for this kind of investor, we are going to guide them to buy this particular asset, because while we are not looking at a higher rental income, low rental income, or maybe no rental income whatsoever, because we are going to be able to flip it, because that's the kind of return they want to generate. We want to get into a high growth area with a great developer where future launches are happening, where we know that the developer's price is going to be increased based on their launch level as well. So it's important to understand that we are looking at high yields, we're looking at low yield, we're looking at high rental income, we're looking at low rental income. So an authoritative advisor not only touts the return but also discusses risk, right? Like what about vacancy rates at that particular asset? For example, it's a great asset you could buy for your investor, which could be in a prime area, it could be a high category asset, but it's important for you to tell them that this asset could take 3 months to get rented, because the demands or the ideal tenant for this particular asset is going to be a large family. It's not going to be that easy. A lot of them are going to come and visit. You also want to be very selective with who you pick as a tenant. You want to make sure that they're capable of paying, that they're going to stay long, that they're going to manage and maintain your asset very well. You don't want your asset being damaged or losing value based on how your tenants are managing it, right? So there are certain vacancy days that apply into that particular investment, which you have to factor in because that becomes part of your ROI calculation. Market fluctuation. For example, if you and the client feel that, look, the market can correct itself, then understand what kind of locations are the first to be impacted. What kind of asset class will be the one which will be impacted first, and what will be the asset class which is probably going to be able to wither that kind of a timeline. So these are the elements that you need to be able to discuss with the investor. And I always tell this to my entire team. You want to build credibility with them, right? But I always encourage my team members to think like an advisor. Don't think like an agent. Your job is not to sell an asset. Your job is to be able to get your investor into a particular property investment and walk them through with it, to be able to generate returns on it and to be able to exit out of it. So they walk away with a profit, and that's when they're going to reinvest it back with you. So it's important to understand that sometimes advising against a risky deal can earn the investor's trust and lead to future business. If you see that the deal that you're looking at, based on all the calculations that you've run, all the scenarios that you've run, that whatever the target of your investor is, whatever their end goal is, if you feel that end goal is not to be achieved based on your own knowledge, based on your own calculations, then advise the investor against it. Tell them that, look, based on all the calculations that we run, based on all the scenarios that we've run, based on my understanding of why you're entering into this investment, why you're buying this particular asset, I don't think that we can reach that goal. We're going to fall short of it by XYZ amount because of XYZ reason. That's great. Tell your investor that I suggest don't enter this investment right now. Don't buy into this asset right now. Either I can explore something else for you, or let's wait for a different time to buy it. This builds a lot of credibility. So many deals are going to come rolling back to you if you're okay to say no to them. And this is a sign of a confident, a comfortable, and not a desperate advisor. This is a sign of someone who's not immediately hungry to close something because they are thinking about their own commissions and not about the client's interest and the client's trust and the client's money. That is the sign of a person that will go a long way. There are a lot of referrals to come through that kind of active advisory deal. So that covers us the topic of day 12, which is about ROI, calculation of return, and looking and talking to your investors based on numbers purely. If you have any particular questions linked to this, please drop them in the comments and I'll be happy to answer them for you.